international markets go is that the volatility to farm gate returns is less than what it would be if the currency was fixed. So back to the world price, the red line, and the black line being an average of the farm gate returns. It's probably a pretty hard sell to say that commodity prices or returns to the farm gate are stable, right? They're not anything but stable. But relative to the volatility on world markets, they are a little bit more stable. Maybe, and I've looked at the numbers, it's about, farm gate returns are about 66% as volatile as world commodity prices. So the movement in the currency, while really annoying, doesn't sort of help too many people. At least it absorbs some of the shock that is going on internationally. So to say, let's think about fixing the currency to abstract from that pain, if you like, it could be the best of a bad bunch of options in the sense that it does shield us from some of the volatility. The problem, if you like, is the world is volatile. We can't really fix it. I guess the question is how do we manage it? And part of that management is having a floating currency to at least take the edges off what would otherwise be pretty nasty. And I think back to the 1960s when we had a fixed exchange rate and the wool boom and bust, the cycles would be even bigger. Even though it's not particularly stable at the moment, it could be worse. Also, the markets responded in terms of oil prices. Prices went really high, right up to 140, and on some measures $147 a barrel. When world growth slowed down really quickly in the fourth quarter of last year, prices come back to 40, back to about $70 a barrel now. We'd actually view that as a positive. We think that when oil prices are rising, it's a really strong indicator that world demand is starting to find its feet, or at least it's not as bad as some people were thinking. So another one of these green shoots, and I sort of, how can I convince you that oil prices going up is a good thing? I'm going to have a go. Think of it this way, from maybe the dairy farmer's perspective, would you like to have $7.90 and pay $2.18.9 a litre as you were last July, or have $4.55 for a kg and pay $1.67.9 at the pump today? Having higher commodity prices is certainly a benefit to New Zealand and New Zealand producers. Part of that mix is having higher oil prices. It means the demand is strong for primary products, which is all good for us. So don't just look at the oil price and think it's a cost. If it's going up and it'll actually use it, when you're driving past the petrol station and if the price of petrol is going up, I'd say that's good. That probably means my prices for my products are going up as well. The benefit of looking at the pump price is it includes the effect of the Kiwi currency in it as well. Have I convinced you? Bail me out afterwards if you're not convinced. Okay, what else is going on internationally is certainly the credit squeeze. If there was one chart that I could put up and say this is the credit crunch, I'd put this one up. Let's have a go at this. This is what New Zealand banks pay, or the big banks pay for funds over and above the wholesale rate, so that it is sort of a measure of the risk attached to getting funds internationally. So when we say that the funding costs have gone up, when banks say funding costs have gone up, this is pretty much, at least on a 5-year term, this is the chart you would point at. And so prior to the credit crunch beginning in July 07, it was pretty boring. If you went back prior to that, it's basically a straight line of about 10 basis points. So this is actually it's not labelled correctly, it's basis points. So up at 220 in the peak of the credit crunch earlier this year, it was about 2.2% more for 5-year funding over and above the wholesale interest rate curve, well, interest rate for 5 years. Certainly the last 3 or 4 months, and it's another one of these green shoots, it's improved significantly in terms of the credit crunch has eased a lot in the last 3 or 4 months. Not to say the last week, it's actually ticked up again. So we're back up to about 100 basis points compared to getting down to 70. Before you sort of think, oh man, it's come in such a long way, why hasn't interest rates dropped? Remember, this is the margin, so that New Zealand banks didn't fund the entire book at the peak, and it didn't fund the entire book at the bottom either. So the average rate, even though the margin was coming down, the average rate would still be lifting. I guess an easy way to think of that is right now, Think of a 2, 3, 4, 5-year loan. If it was rolling over, compare the rate now at about 90 basis points. Look back, say 2 or 3 years ago, it was about 10. The average cost of funds is still well and truly above where that loan originally was set at, if you like. But as an indicator of what's happening globally in credit markets, certainly a big improvement from the beginning of the year, and that's all good for some sort of recovery economically into next year. Policymakers haven't been sitting on their hands. All this increase in credit spread, so that risk factor lifting, policymakers have been saying, geez, the last thing the economy needs is higher interest rates. Let's cut the official rates, like the OCR in New Zealand or the Fed funds rate in the US. And so we've seen the dotted one, the Fed funds in the US down to 0.25, our official cash rate down to 2.5, the Aussies down to 3, the Brits are sub 1. Extreme policy measures for the extreme squeeze that come on. So that was trying to offset that big increase in risk and credit spread expansion that I had on the last chart. To some extent, New Zealand and Australia has had a bit of success in the sense that outright interest rates have actually fallen, even though there's a credit squeeze going on, thanks to the official cash rates and the flow-on effects from that coming through the system offsetting. So we've got the 90-day rate certainly coming down and likely to remain quite low for an extended period. I guess feel another forecast coming on. Where's interest rates going? We think the Reserve Bank, in terms of the official cash rate, has probably done enough in the sense that they think the world is starting to recover. They do hit the official cash rate at 2.5. That's giving a lot of support to the economy. Interest rates, even at the retail end, are at pretty low levels. So they're thinking, let that work through the system and recovery will happen maybe late this year or 2010 for the New Zealand economy. But I think the key message for interest rates, not necessarily whether they get cut again, but they're likely, at least at the short end, likely to remain pretty low for an extended period. So if you listen to what Dr. Bollard's saying now, it's very much towards the second half of 2010 before he's thinking about lifting them at all. So, and that's, dependent on what happens internationally. So it's likely to remain low for an extended period, which at this point you put to the second half of 2010. I think quite a different story at the longer end of the curve, which is market determined. I think there's big pressures upwards for longer term interest rates. The idea that the world will be recovering in the next 5 years, one hopes. Maybe it's not for a year, but then there's 4 years after that for the 5-year term to be thinking about. So the growth prospects are probably better. Inflation will become more of a concern because the Yanks have printed so much money and the recovery will be driving up prices. Governments have borrowed a lot of money internationally. You think of the 1.15 trillion out of the US. What's a trillion? Anyone? I looked it up on Google, it's 12 zeros. It's a lot of cash, so that's going to come through the system. The government's competing for cash, international governments are competing for cash just like everyone else. That's driving up the long-term rates, and the Reserve Bank of New Zealand yesterday announced a new liquidity measure for domestic banks, which is saying domestic banks need to lengthen the duration of their funding. So that will put pressure on the domestic banks to go to the money markets, have to buy longer term money by regulation, so that's going to flow through to higher retail rates as well. Puts is likely to. The Reserve Bank suggests the new policy might be 10 to 20 basis points. We'll have to wait and see, but and the commercial banks in New Zealand have got 2 years to implement this thing. But again, another upward influence on interest rates, and I would think especially at the longer end of the curve. So short-term rates likely to be low, long-term rates, it feels like upward pressure more than downward pressure from quite a number of sources. Okay, back to this credit spread. So there's the red line, which I talked about before. Then to try to think, what do we actually get charged at the retail? What does farmers actually get charged? So the credit crisis began back in July 07. Lehman Brothers collapsed September 08. That sort of was the two big events, if you like, in the international credit crisis overall. Then the swap rate, if you like, I don't want to get too buried in this, but the actual wholesale rate fell a long